A very good day, everyone. We are from Group 8. I'm Lim Lucy, and my teammates are Tan Wei Ping, Gam Pi Long, Cheryl Tan Ziying, Chen Luo Shen, and Leong Jia En. In this video, we'll look into the introduction, causes of SVB's collapse, the SVB's current crisis, recommendation for SVB challenges, effectiveness of SVB leadership team in addressing the crisis, and last but not least, the conclusion. Silicon Valley Bank, or SVB, was founded in 1983 to address a critical gap in the financial sector. Due to traditional banks were reluctant to support the high-risk tech entrepreneurs, this made an opportunity for SVB to step in, catering specific to the tech and innovation industries. Even though SVB gained a competitive edge, it also becomes deeply tied to the fortune of these volatile sectors. Over the years, FVB grew alongside with tech industry, serving nearly half of all venture-backed tech and life science business in the US. However, this came with challenges. SVB heavily invests in long-term assets like US Treasury bonds and mortgages-backed securities, many of which were designed as yield to maturity, limiting flexibility when the market conditions shift. In 2022, SVB faced a perfect storm. The Federal Reserve rapid interest rate hikes devalued its bond portfolio, while a downturn in the tech sector reduced client confidence. To make the matter worse, the bank operated without a risk officer for much of the year, leaving a critical gap in the leadership at a time when strong risk management was essential. The collapse of SVB became the most significant bank failure since the 2008 financial crisis. This case highlights the dangers of concentrated business model, rapid growth without adequate safeguards, and the dependency on volatile industry. It served as a vital lesson for financial institutions about the importance of diversification, leadership, and proactive risk management.
I would like to share with you the story behind the collapse of Silicon Valley Bank, a financial institution that fell victim to a combination of poor decisions and external economic pressures. Firstly, Silicon Valley Bank has overweighted held to maturity securities. During the low interest environment of 2021, Silicon Valley Bank experienced a massive influx of deposits, growing by 85.5% from 102 billion in 2020 to 189 billion in 2021. However, due to low loan demand and short-term yields, Silicon Valley Bank decided to heavily invest in long-term fixed income securities. By 2021, held to maturity accounted for 46.4% of Silicon Valley Bank's total assets. While these investments are generally low risk, Silicon Valley Bank's over-reliance on them exposed the bank to significant interest rate risk when rates began to rise. Silicon Valley Bank has poor risk management. In April 2022, Silicon Valley Bank's chief risk officer resigned, and the position remained unfilled for 8 months. During this period, interest rates surged by 400 basis points. Yet, the bank's management failed to hedge against this risk. Instead, they chose to hold on to their securities, underestimating the Fed's determination to combat inflation. Ultimately, Silicon Valley Bank wrongly assumed interest rates wouldn't rise further. Silicon Valley Bank has a non-traditional deposit base, heavily reliant on early-stage tech and life science firms. These firms face financial strain as borrowing costs increase, leading to widespread withdrawals to meet liquidity needs. Unfortunately, Silicon Valley Bank's capital was tied up in loans and losing held-to-maturity securities, leaving it with insufficient cash reserves and creating a severe liquidity mismatch. When Silicon Valley Bank attempted to address its liquidity crisis on March 8, 2023, it announced plans to sell 21 billion worth of securities at a 1.8 billion loss and raise 2.25 billion in capital. This announcement triggered panic among clients, resulting in a massive 42 billion withdrawal in just one day, a textbook example of herd behavior in the financial markets. On March 10, 2023, the authorities closed Silicon Valley Bank due to its inability to fulfill its obligation, and the Federal Deposit Insurance Corporation (FDIC) assumed control of the company.
Now, we will focus on three key risks that play a major role in SVB collapse, which are idiosyncratic risk, interest rate risk, and liquidity risk. First of all, SVB was exposed to high idiosyncratic risk due to its business models, which was heavily concentrated on a specific client base, particularly venture capital-backed firms. This tied its performance closely to the tech industry business cycles. During the pandemic, this startup experienced rapid growth, leading to a surge in deposit. However, in the post-pandemic period, raising interest rate placed this firm under financial distress, prompting a wave of deposit withdrawal to sustain their operations. These concentrations created significant liquidity challenges for SVB, as the available funds were insufficient to meet client demand. Secondly, SVB relies on long-term investment, such as 30-year term US Treasury bonds and mortgage-backed securities, expose it to interest rate risk. As the interest rate increased, bond prices decreased, and the values of SVB holding plunged. Mortgage-backed securities were further impacted by slower prepayments, extending cash flow, and reducing market appeal. These unrealized losses significantly weakens SVB financial stability. Finally, SVB encounters severe liquidity risk. SVB relies on short-term deposit to fund its operations, while a significant portion of its asset was tied up in long-term held-to-maturity security. Therefore, when the central bank raises the interest rates, these existing securities become less attractive in the secondary market, making it difficult for SVB to convert them into cash at favorable prices. As a result, when clients make substantial withdrawal requests, SVB experienced a cash flow crisis.
As we hear about the crisis about Silicon Valley Bank, crisis could have been prevented if these three solutions been executed out, which are stricter supervisory standards, restructure Silicon Valley Bank board of directors and senior management, and diversification of customer base. Banks with assets under $100 billion of assets, which include Silicon Valley Bank, was exempt from the enhanced prudential standards such as stress testing. However, given Silicon Valley Bank its rapid growth to $211 billion of assets in 2021, Silicon Valley Bank should have undergone stress testings, which were the same standards same as JP Morgan and Citibank. Through stress testing, Silicon Valley Bank can stress test their liquidity position and risk associated with their portfolio under a rising rate environment in a hypothetical situation. In this hypothetical situation in advance, this can help Silicon Valley Bank management to determine the optimal balance of cash on hand to satisfy the high withdrawal rates, and meanwhile, still can intelligently diversifying in the investment in the right asset with the right duration. And one of the examples of stress testing is Silicon Valley Bank can assess the liquidity coverage ratio and net stable funding ratio to address the liquidity risk. If there are stricter requirements of stress testing, Silicon Valley Bank would be expected to comply promptly and result in improved liquidity ratio to withstand market stress at the publication of results on 8th of March 2023. However, everything comes with its risk. Tighter regulations could limit SVB to operate freely and may lose its competitive advantage. Silicon Valley Bank grew quickly, especially during COVID-19 era. But as it grew, the bank overlooked one critical element, which is effective risk management. The board of directors prioritized short-term profits over long-term stability, leaving the bank vulnerable. Silicon Valley Bank concentrated deposit base and high uninsured deposit made it fragile, especially in a rising rate environment. Yet, risk management was just treated as a checkbox exercise, not a strategic priority. So what was needed? A leadership team with expertise in risk management. Leaders who value stability over quick gains, diversify depositor base, and improve liquidity. If Silicon Valley Bank embraced sustainability over short-term gains, it could have been mitigated its risk and weathered the storm. But here's the challenge. Shareholders often focus on immediate profits, not long-term resilience. Appointing risk-focused leaders doesn't always align with investors' expectations, especially in Silicon Valley, where quick returns are the norm. Another thing that differentiates Silicon Valley Bank from other banks is the specific group of customers, which are venture capital and tech startups. Specifically because SVB heavy reliance on this sector make it vulnerable. So what could they have done differently? The answer is diversification of customer base. Instead of operating and depending on the concentrated and high-risk depositors, Silicon Valley Bank could have expanded into more stable industries like retail, consumer goods, manufacturing, and real estate. By attracting smaller accounts from these sectors, the bank could have reduced its exposure to sudden and large deposit outflows. However, diversification isn't without its challenges. Different industry comes with different risk profiles, and expanding into new sectors means hiring more experts, managing more complex operations, and dealing with higher costs in order to address credit risk. So to sum up the recommended solutions, Silicon Valley Bank could have prevented a collapse if there is a stricter supervisory standards, restructure the board of directors and senior management, and diversify its customer base.
Going to talk about the effectiveness of SVB leadership team in addressing the crisis. The SVB management failed to strategically reassess their current problem that they face. On March 8, SVB made two simultaneous announcements, issuing 1.2 billion in the common stock and selling 21 billion in security, resulting a short in 1.8 billion after tax loss. While these moves were intended to provide liquidity, but they unintentionally triggered a financial crisis in the market. This was interpreted by the market as an indication of cash shortage, which caused widespread panic among the depositors who were afraid for their money. A bank run occurs as a result of this panic. Even worse, issuing common share weakened confidence by implying ownership dilution for current shareholders. On March 9, the next day, SVB financial stock plumped 60%. Besides, a lack of leadership can be evidenced in poor risk management. For most of 2022, SVB operated without a chief risk officer. After the resign of a former CRO in April, her successor, Kim Olsen, was not appointed until January 2023. During this 8-month gap, the Federal Reserve raised interest rate 5 times, totaling 4.25 percentage points. Given that SVB customer base was primarily venture-backed IT and life science company, this has a serious consequence for the company. By the end of 2022, 94% of SVB deposits were insured, making it highly vulnerable to rapid withdrawal. Rising interest rates make it harder for the tech company to secure affordable financing, increasing their reliance on their deposit at SVB to sustain operation. This surge in withdrawal exposed SVB liquidity risk, a direct consequence of its unbalanced portfolio and poor risk management. Compounding the issue was SVB overinvestment in held-to-maturity HTM asset, which grew by 592% between 2022 and 2021, reaching 98.2 billion. This investment was made during a low interest rate environment, and as rate rose, the market value of this asset dropped significantly. When SVB was forced to sell this security to meet withdrawal demand, it incurred 1.8 billion loss.
To conclude, the collapse of Silicon Valley Bank served as a stark reminder of the risks associated with specialized banking model. While SBB focused on the tech sector initially provided a competitive advantage, its narrow concentration made it vulnerable during periods of economic volatility. The reliance on long-term held-to-maturity security, paired with the absence of chief risk officer during a crucial economic transition, compound the challenge. When faced with a rapid interest rate hike and liquidity pressure, SVB struggled to adapt, ultimately lead to a liquidity crisis and a bank run. Next, what lesson can we draw from this? Stronger supervisory framework, including reduced stress testing, diversified deposit base, and proactive portfolio risk management, are important. Equally critical is cultivating a culture of strategy leadership, one that prioritizes effective communication, anticipate market reaction, and instill confidence among stakeholders in time of uncertainty. Furthermore, the role of leadership cannot be overstated. Poor market signaling during the security sales announcement soured panic instead of confidence. This highlights the needs for effective communication and a solid contingency plan to maintain depositor and investor trust in time of uncertainty. For other institutions with similar business model, the path forward is clear. Prioritize diversification, appoint a dedicated leadership team, and maintain an open, transparent communication with regulator and stakeholder. These principles are essential not just for weathering crises, but for building long-term resilience. Silicon Valley Bank collapse is a cautionary tale, but it also serves a valuable blueprint for financial institutions seeking to fortify their operation and navigate the complexity of today's economic landscape. Let this be a call to action for the industry to embrace change, foster innovation, and safeguard the stability of our financial system. That's all for us. Thank you.